the world has changed in the last 50 years, and we shouldn't continue to use the same systems to underwrite and to deploy financing that we did back in the 50s, which is how most banks operate.
Today, I'm sitting down with Dimitry Gershenson, the co-founder and CEO of Enduring Planet. Dimitry and his team provide non-dilutive funding to early-stage entrepreneurs with a focus on emerging climate technologies.
Right, equity is the most expensive capital you'll get. And so in this case, they came to us and we provided them a loan, and they were able to then buy all that equipment, hire their people, not take on dilution, and they pay us when the government pays them.
We're going to dig into the importance of non-dilutive funding for these entrepreneurs and why it's so important if we're going to build a more decentralized, clean infrastructure to power the next generation of economic activity. I hope you enjoy the conversation, and remember to go direct. All right, I think we are live. Cool. Hey, Dimitri, how are you doing?
Good, man. So good. Thanks for having me.
It's good to see your face.
Ditto.
It's been a while.
It has been a while. Too long.
So for all of you out there, so I met Dimitri, I don't know, but probably 4 years ago now.
2021.
Is that right? Yeah, 4 years ago. And in disclosure, I'm an early investor in Enduring Planet. And so kind of I'll frame this up of why I thought that it made sense to have a conversation, because I think it's highly relevant. So, if we ever want to move kind of these large centralized dirty systems of production to more decentralized clean ones, which is kind of the whole premise behind going direct, obviously technology will be a big enabler of this. And a lot of this technology will look a lot more like infrastructure oriented investment. And so the builders and people out there building these technologies, they need to think a little bit differently around capital formation and how to fund their businesses, because as we know, the traditional venture model doesn't really fit into this. Many people, which we'll get into, are stepping into this gap. But if you're working in the real economy, the concept of non-dilutive funding is really, really important. So anyways, let's hop into it. All right.
Yeah, let's do it.
Okay. So, one of the main lines of business for Enduring Planet is to provide non-dilutive funding to early stage entrepreneurs, specifically focused on climate technologies. So can you just start by, how do you define a climate entrepreneur?
Yeah, we take a pretty broad definition by design. Our belief is that a transition to a new climate economy sort of requires all of the spaces to transform. That means everything from, cement becoming a lower emission input, to having lower emission diapers, to having improved wildfire management in forests. The whole ecosystem, the whole economy needs to transform. And so for us, anyone who is supporting the reduction of emissions, the removal of emissions, or greater resilience for communities and businesses is in scope for us. And we also don't require, many providers of financing in this space, they look for measurable climate impact. And we say, well, there's a lot of solutions that are actually relatively indirect. And we still want to finance those because they are required for the ecosystem to exist. So we don't have a requirement that someone has, a gigaton of emission reduction. That's not for us.
Cool. And can you just talk a little bit about when this kind of idea came up and why you wanted to pursue this, and why you think kind of this non-dilutive funding and working capital is so important for this transition and just for more resilient, planet-friendly economy, I guess I would say?
I mean, I think the first thing to sort of accept is that we exist in capitalism, right? Capitalism is not going away. This system that we've created is what drives a lot of the deployment of technology, adoption of technology. This is the model we've chosen for now, right? And if you sort of accept that premise, then any ecosystem transformation, or I use the term ecosystem maybe very loosely here, not in the ecological sense, but any transformation of this type requires an insane amount of capital. mean, if you look at all the analysis, like $5 to $10 trillion a year of investment required to get our society to a future that is actually sustainable. And uh, depending on who you ask, 20 to 40% of that is debt, because it just doesn't make sense to finance a lot of this work with equity. And oftentimes founders ask me, they're like, how do I decide what to finance with debt versus equity? And the answer is actually, at a very high level, relatively simple. If you have a predictable outcome that you need to finance, that is where debt is most useful. You have a purchase order from a large buyer, you need cash to buy equipment or buy inventory, that's a great use for debt. If you're doing innovative R&D where the outcome is not guaranteed, that's a great use for equity or grants, right? Things that don't have a fixed repayment horizon. And so as founders construct their capitalization strategy, what they need to think about is like, how do I pay for X outcome? Not how much money do I need to raise? That comes later. And so what we saw when we started Enduring Planet is that there's a significant gap in the credit ecosystem for climate. And that gap is really pronounced for earlier and smaller stage companies. Like there's plenty of players giving $200 million loans to mature companies. That will always exist. That's like a commodity market. But for anyone trying to get, anywhere from like 100 grand, $5-10 million worth of debt, it's pretty hard. Pretty hard. And also a lot of the infrastructure that's been developed to deploy that kind of capital is built on relatively conservative and kind of like antiquated perspectives on deployment of money. And the world has changed in the last 50 years, and we shouldn't like continue to use the same systems to underwrite and to deploy financing that we did back in the 50s, which is like how most banks operate.
And so let's drill into this gap, because obviously traditional, I guess, banks, lending institutions, right? They also have other restrictions and covenants and all these other things that they have to deal with, and reserves. I want to drill deeper into this because I want to discuss, let me step back. Sorry. So one of the benefits of capitalism and the free market is typically capital finds opportunities and typically will solve the problem over time, right? When it comes to capital needed, if there's investable opportunities. And so drill more into this gap that you mentioned, because I think it's really important to understand. Because for most people, it's like, hey, there's banks everywhere and philanthropy and all types of new project finance funds popping up. So
yeah, I mean, I think in the end, it boils down to the perception of risk, right? And we talk about this delta a lot, the like delta between perceived and real risk. And if you look at any developed capital market today, you'll find that throughout its history, what sort of participants do over time is reduce perception of risk until perceived risk and real risk are aligned. Right? So, for example, solar financing is a really great, within climate, a really great example. Right? So there was a time not too long ago where you could not get financing for residential solar. In the last 15 years, you just could not do it. It didn't matter what credit you had to buy the system up front. And groups like Mosaic and others kind of came into the market and said, okay, actually, we can show institutions, big financial institutions, the folks that manage $1 trillion, that actually the perceived risk of these borrowers is inappropriate. The real risk is much lower. And that happens over time. So you have these emerging managers, smaller players, they take maybe different forms of capital. They might blend capital. In our case, like we started using effectively concessionary risk comfortable capital from foundations and family offices and donor advised funds. And we said, okay, we're going to prove that you can lend $100,000 to a 2-person team coming out of a national lab so they can execute on a Department of Energy grant. That's like one of our starting theses. We're like, oh, we can lend against government grants. A lot of people don't do this. They don't think grants are as sort of safe as we know them to be. And so what we've sort of found is that across the climate ecosystem, and this is true probably across the broader ecosystem of listeners of this podcast, right? Is that in a lot of spaces, there are these opportunities to finance relatively predictable outcomes for teams that are seen as inherently riskier. The perceived risk is very high, when in reality, the real risk is actually relatively low for that transaction. And this is true, I would say, anywhere in the climate space today, up to like the $10 million per deal mark. Like sub $10 million, there's still a lot of, I don't know, like a lot of bullshit. Just people thinking that it is not possible. And we go out there and we do it and do great.
Well, I think what you're saying, it's when the traditional way they'll say, well, for me to underwrite $1 million loan or $500,000 loan is the same amount of work for me to do a $10 million loan, right? Or $100 million loan.
Well, this is one of the things that I also find really interesting is we found a path towards dramatically reducing the cost of underwriting. And so even as we scale our lending, we started writing 100K to max 500K checks. Now we write up to $2 million checks, right? We still do 100K checks. And when we write $100 million loans, we'll still do 100K checks because our cost of underwriting is so much lower than the average financial institution. And that's a mix of technology that we've built ourselves, technology we've adopted, but also like where we hire talent. So we have a fully remote company. We hire almost all of our talent actually in Pakistan. We don't outsource. There are employees. They work for us. A lot of them have equity. They're directors, senior VPs in our company. But we sort of realized, in part through our prior work before and during Planet, that there's this incredible finance talent market internationally that can support the same work at a much lower price point. And so when others in the US hire analysts out of, banking and they pay them $250,000 a year, I'm like, yeah, sure. With those economics, you have to do 10, 20, 50, $100 million deals because your 6 months of underwriting costs you, like an insane amount of money. And we actually, if you do the math, once we're kind of operating at full deployment, our cost of underwriting is often covered by the origination fee alone.
Talk to me about kind of your own capital formation process. So obviously you're lending, but then you've had to raise capital and bring basically a debt fund, right, to be able to place capital. So kind of walk us through the evolution of how you started and where you're at today.
Yeah, I mean, I think we took a somewhat non-traditional approach to building a fintech lending business. The typical model is that you raise a bunch of VC money, you go out and get a warehouse facility. That warehouse facility allows you to deploy capital relatively quickly, but often it's very expensive. And the advance rate on that facility, and for those who don't know what that means, like a typical partner for a fintech lender will say, hey, for every dollar of a loan you want to put out, we will put in 70 cents and you put in 30 cents off your balance sheet. And then the other thing that's always kind of funky about these warehouses is if you underperform, if you have a default, you are required to buy out that loan out of the facility. The lender does not want to have the bad stuff. They don't want to share risk with you. They want you to own it. And what that means is that fintech lenders have to raise an insane amount of venture capital to get to a place where they can actually lend profitably. Because oftentimes the pricing on these facilities is so high that if they want to compete in market against everyone else, they basically have to lend at cost or even below cost. And as soon as they have default, they have to buy out those loans and bring them onto their balance sheet. We said we don't want to do any of that. It's like not appealing to us. We'd rather move slower, but we want to have good unit economics from day one. And so what we did was we said, okay, we'll raise a modest amount of venture capital to support our technology development, our executive team, et cetera. and then we'll go to market and we'll actually launch a debt fund. And we did that our first year. We closed a pilot fund of about $5 million. We've done over $20 million of investing out of that fund now, because it's like a 5-year fund and we can revolve capital relatively quickly. And then from that experience, we kind of started to hear more and more from the market about what people wanted to see in an offering like this. And so the second fund, which we're currently raising, we already did a first close, but we're currently raising, it's actually a quasi open-ended vehicle where we can keep issuing more notes into the same fund and raising more debt. And what that allows us to do, one, is it gives us way more control over how we allocate capital to our borrowers. We sort of set the terms as opposed to being beholden to a warehouse facility lender. And we can structure it in a way that doesn't feel as painful. And so our pricing is better. Our advance rate is way higher, like 95% in Fund 2. And what that means is that we can lend at a reasonable margin, not take a loss on our loans on day one. And we don't have to make our borrowers pay an insane premium. Because if we did our second fund as a debt facility, our cost of capital would probably be 600, 700 basis points higher, which then we have to pass on to our borrowers if we want to like even make margin on our loans. And so the long-term strategy, I think, is to sort of build an institution where we can get our lending work rated by an independent party and then float a green bond. That for me is the most exciting path forward.
Explain what that means, because
yeah,
I'm pretty sure
it's a
the
good
majority of
question.
people don't know what that means. So yeah, but
Yeah,
interested in kind of that.
so bond markets are really attractive because, you know, I think most people know what bonds are. They're like institutional rated securities where you can buy them and you get a fixed return, you know. And the green bond market is really, really attractive to people. So for large institutions that want to commit capital to decarbonization or climate impact or whatever, and there's, I don't know, it's like $1 trillion floating in the market today, they love the idea of a fixed income instrument that is rated. The challenge is that those are very large institutional markets where the minimums are not small. Like I think before you can effectively go and think about doing a rated bond, you have to be at like 250 million plus in volume, right? But there are examples that we really like in the space. One is Calvert's impact bond. So Calvert sells these impact bonds to large institutional investors. The pricing is really good for impact, but also very attractive for Calvert as a lender. They've done, I think, like $3 to $5 billion at this point this way. And what this has done is in some ways like created an understanding within the market that this instrument is a useful tool for getting capital in the hands of impact entrepreneurs. And so we want to like replicate the same model. We find it really exciting.
So if you project that out a little bit, right? So you're out raising an open-ended vehicle. At what type of scale would you need to be to actually issue a bond, would you say?
I think the number is a quarter
Agreement.
billion. I think it's
Okay,
a quarter
it is.
billion. Like there is a chance that we can go earlier. We're having conversations with folks now to see like what is the smallest amount that we could effectively float, where a rating agency would actually take a look at it, would do the work, and where it's also worth it to us because there's a big cost associated with floating a bond. But that's definitely like, I mean, obviously anything can change in 6 months or a year or 2 years. You might ask me, and I'll say, well, we decided not to do it. But for now, that feels like the most appealing path forward.
And let me ask you maybe it's a question because I'm not educated on it. Is that if you were to go down that path, are you taking your current lending portfolio and issuing the bond, or you would issue the bond to deploy new capital?
Yeah, that's a good question. So generally what we would probably do is the bond would, you would get your existing portfolio rated, you would float the bond, you would use that to buy out all of your existing like higher cost debt, and then the capital would just allow you to then recycle, right? So you would still do new loans out of that financing. It's not like the bondholders would just hold the existing portfolio, because it wouldn't make sense. Our lending is so short term, and most people who want to own a bond, they're looking for 3, 5, 10 year timelines, and having like 6 month loans that just repay is not reasonable for them.
Cool. So let's make it less abstract, just so the audience can understand a little bit better. So just give me an example. If I'm an entrepreneur building XYZ, give me an example of, I come to you, broad terms, length, to give a sense of the type of companies you work with.
Yeah, so we do two kinds of lending today. We lend against government receivables, and then we lend against commercial receivables. And the structures are relatively similar. Like we basically say, okay, you have a contract with X party. We can use an example of, we have a company in our portfolio that develops an innovative material that is a low carbon replacement for steel and other metals. Okay. They have a big grant from, of, I think it's a federal grant. It might be a state grant. It doesn't matter. They have a big grant. And unfortunately, the dynamics of a lot of these big grants is that you have to do the work. You have to submit a report after you've done the work. You have to submit an invoice, and then you wait anywhere from 30 to 180 days to get paid. And that cash flow dynamic can be really difficult for small businesses. And historically, what people have done is they just raise more equity. They're like, oh, we just won a $2 million grant. We'll raise $500,000 as a seed extension, and that will allow us to finance this work. And the problem is that that's incredibly painful. It's dilutive. It's disruptive, and it's the highest cost of financing you can possibly get, right? Like equity is the most expensive capital you'll get. And so in this case, they came to us and we provided them a loan, and they were able to then buy all that equipment, hire their people, not take on dilution, and they pay us when the government pays them. And it's been going great. We'll hopefully do many more of these with them. But we also do the same in commercial settings. So folks will have, we have a client who sells to large corporates. They do like biodiversity related services. It's super cool. And obviously those corporates, they're like, well, we want to see the thing installed on our campus, and then we will pay you on our terms, which are usually then 90. And so that can also pose challenges. And in those cases, we can actually, in both circumstances, we can actually look at a basket of contracts and say, oh, well, you have $350,000 grants. Well, we can actually lend you, 350 grand across all of these. We don't have to just pick one. And so we actually post case studies on pretty much most of the transactions we've done, as long as the company is comfortable with us publicizing. So folks can go on our website and take a look.
Great. And typically, how long is the financing is typically tied just to the receivables? Or are you doing other type of working capital lending and other financing beyond the grants as well?
Yeah. So generally, we are lending against predictable income, but we have done transactions where, for example, we did one deal with a company in the carbon market space where they actually wanted to acquire a producer of biochar, and they needed extra capital to do that. And so we said, okay, well, we can underwrite your business. You have plenty of revenue. We're not worried about the cash flow. So we'll support this acquisition. And in that regard, like we underwrote all of their contracts to understand what their income looks like, but technically the use of funds was actually to do this acquisition on the side. So we get pretty creative. We try to. One of the things that we're really proud of is that we move relatively quickly. We try to issue term sheets in about a week and fund in about 30 days after signing the term sheet. And so the more creative we get, the longer that process gets. And so we want to make sure that people are coming to us and have the right expectations. So we publish all of our terms on our website. Nobody should ever be surprised about the offer that they get from us. And we take a lot of effort to make sure that our clients don't ever feel like they're wasting their time. Like that, to me, is the worst thing that we could do to a founder, if they come to us and they waste their time. And it has happened. Like we actually just had a case where we had someone come to us and say, hey, I have this contract that I want to get financed. And we said, well, cool. Do you have experience doing this work before? Because for commercial term lending, when we're lending as commercial contracts, we can't really take performance risk. And the team said, oh, yeah, we have plenty of experience doing this. And then it turned out that they had experience as individuals doing similar work in other companies, but had never done it as themselves, right? Like as this new entity. And we had to say no. And they were really frustrated because we had asked them, do you have experience? They said yes. And we said, cool, we can do this deal. And so now we've actually redone our entire intake process as a result of this one transaction last week, where we're like, okay, we need to change how we ask these questions, because what we don't want is for folks to come and think they're going to get a deal when in reality we can't do one.
Yep. And what's the cost of capital range?
Yeah, so we typically lend kind of at like 15 plus. So we start at 15% APR. We generally, for us to do a deal at 15, the financials have to be like really impeccable and there's very minimal risk, right? Generally, we land at around 16, kind of average, 16.5. For our government receivable lending, we secure exclusively against the receivables from the contract. So we don't do like a blanket all asset lien. We don't take personal guarantees. We don't do warrants. We, from what I've seen in the market, we're some of the cheaper capital available for that type of borrowing. There are exceptions. Obviously, if you can get a bank to do that transaction with you without a personal guarantee and without an all assets lien, then it will probably be cheaper. But from the private credit ecosystem, we're some of the cheapest. On the commercial term lending side, it starts in the same ballpark. We generally land probably at 16.5 or a little higher, but there we will typically take an all asset position in terms of security. So we will secure against the cash, the receivables, et cetera. And that's just because commercial contracts are inherently more risky than government ones. And there I would say we're like kind of at market or slightly below the average cost of financing and market for borrowers like the ones we target.
Yeah, it's interesting. I speak to a lot of founders about this in general because it's interesting. A lot of times people will hear the interest rates where the market's at, or when you're doing receivables financing, oh, that's really high. But what they don't understand is it's usually a shorter period of time, right? 3, 6, 8, 9 months. But I try to tell people it's actually much more costly to your business to slow down and not execute. And the idea should be you're building actual enterprise value. That's what you should be focused on. You shouldn't be focused on, oh, well, it costs X percent more for this capital. It's like you should be focused on the bigger picture. Have you found that to be a challenge with some of the entrepreneurs you're working with, just because when they see the rate or whatever, they're not used to something like that?
I think it's really interesting to me. This is like a hill I will be happy to die on. I think most founders don't understand the cost of financing, or if they do, their perspective on it is rooted in a past that no longer exists. So, like, one, we have founders come to us and they're like, "Oh, I don't want to borrow over 10%," and I'm like, "That financing hasn't existed since interest rates were zero for you." Like, yeah, you could hypothetically, maybe you can get a venture debt deal done at 9 today or at 8 or 9, right? Which is inexpensive. But you have to remember that when a bank does a venture debt deal with you, one, they're making a bunch of money on the fees for holding your money, right? So you usually have to move all your financing to them. Two, there's warrants, which are worth not an insignificant amount of money. And then there's also like lots of fees hidden throughout the process where depending on what happens, that interest rates can creep right up. I also often ask people, I'm like, well, do you have a corporate credit card? And they're like, yeah. I'm like, do you know what the rate on that card is today? And they're like, no, I haven't checked it in a while. I'm like, you understand it's like 28 or 29%, right? Like, we're talking about half of the cost of that capital. And then I think to your point, I think a lot of founders also struggle with the counterfactual, right? Like if I don't take this financing, oh, well, I'm saving on this interest cost, but you're now moving slower. You're like delaying projects. And honestly, it's really, really difficult to evaluate the impact right? And so this is actually where our second line of business comes in, because we also provide financial advisory services to climate companies. We'll do their accounting, we'll build their financial models, we'll build dashboards, we'll build projections. We are very careful not to advise our borrowers on what to do with their money. We have kind of a wall to protect ourselves from that conflict risk. But in general, what we've also identified in the market is that there's a pretty big knowledge gap. And folks often don't have the resources or don't think to invest in the resources to do those projections and to say, okay, well, if I take on this capital, what happens to my business? If I don't take on this capital, what happens to my business? And so it's interesting because I feel like when equity capital is plentiful, people complain about the price of debt more because they're like, oh, I can just get this free money. And I'm like, dude, that money has 100% IRR. Like, that is the most expensive money, but it feels free now. But now that we're seeing equity markets, especially in climate, soften, we've had people who have told us at like 6, 12, 18 months ago, I'm not interested in your financing because it's too expensive. And like, we just signed a term sheet with one of those folks who was like, I will never go over 9%. And now we're here.
Yeah, I think it's going back to the same thing of just not understanding cost of capital. It's just like not understanding cost of capital and market dynamics. So, what the main kind of theme behind going direct is decentralization. And one of the things, that I really like about many emerging climate technologies is they're inherently decentralized, whether that's rooftop solar, microgrids, we can go on and on and on.
Yeah.
Can you talk anything about any work that you're doing in this space to kind of help move to more decentralized systems, or anything that you're lending against, just for the folks out there to get a better
Yeah. I
understanding?
mean, we've done a lot in that space. We funded a lot of innovative clean energy production, modular clean energy production technology. We've done a bunch of work in the storage space, in the EV charging space, which is obviously like massively decentralized. We've done some work in the like kind of circular economy space, which I think is, you know, like in some ways, the way that we do waste management is inherently centralized, but we have partners who take a more local and kind of like, how do we do this more efficiently, faster, in a more decentralized way? I think that in general, what's interesting about the decentralized technology space is that paired to its like very centralized counter kind of like model, it requires even more creativity around capital and structuring and management. Because let's say you have two businesses, one that builds 50 microgrids and one that builds the same amount of gigawatt capacity, but in one facility. If they both have experience and track record and blah blah blah, like let's say they're equivalent in everything but the structure, it is way harder to finance the microgrid deployment. And it requires an incredible amount of sophistication to bundle those projects, pool them together, find investors who are comfortable with that model, and for them to then commit capital to it. And I think that people kind of naively assume, well, oh, these are smaller projects. Individually, there's less risk. It's diversified. But the fact is that that's not how capital markets view it. And this has been a problem since I started in climate 15 years ago. I actually wrote my master's thesis on microgrid finance in developing countries because like no one could figure this out. They were like, well, we don't know. The projects are too small to finance individually. And I'm like, it actually isn't that hard conceptually, but capital markets are not traditionally innovative or creative. And a lot of financial institutions will look at an instrument, project debt, and they will put it in a box. And as soon as you are outside of that box, it's just not even worth it for them to think about.
Yeah, it goes back to this kind of two things: is the underwriting process, but then the skill set of the people doing the underwriting, right? And then the desire, right? The desire to lean in and say, actually, this is interesting because this is something that I want to be a part of, rather than putting it through some sort of model and saying this works or this doesn't work.
Unfortunately, credit primarily works like the latter thing. And
For sure. Well,
that's sort of the point, right? Like credit
sure.
is meant to be we look at the downside risk only. We don't care about the upside. We don't care about the story. But what I think happens is that um, people are trained in financial institutions today to think about finance as a set of discrete instruments and a set of discrete opportunities. And in reality, there's infinite gray space in which people then innovate. And this is true. I mean, look at like some of the largest financial institutions today, right? The like trillion dollar asset managers. Um, and I'm trying to remember, God, what are they called? Not Blackstone, but there's one of these players that manages a monster amount of financing.
BlackRock,
And
Blackstone. I don't get them confused.
yeah, it doesn't it's like it almost doesn't matter. They're all kind of the same, but they built their trillion-dollar business on providing debt financing to private equity to do acquisitions. And this was a space where when they started, nobody would touch it. It was like definitely not. And now it's, some of the biggest asset managers, this is their biggest allocations of portfolio. And I think this is just like this is true in any capital market where somebody has to take that first step and say, actually, we believe that this is doable. And we will use capital that's more flexible to prove out this model. And then as we get bigger, we're going to come back to these institutional folks, the big banks, the big, Blackstones, the BlackRocks, all the different, you take two words and smash them together and call it an asset manager. Like you can go to all those folks and say, okay, well, hey, we've done 100 million of these. And you think the risk profile here is this, but in reality, it's this. Now let's talk. And so that's my hope is in climate. I think there's one thing too that's really hard for people to price, which is that as the world burns and gets, by the way, is there like how do you handle language on this podcast? Am I
However
allowed
you
to?
want to, however you want to do
Great.
it.
We're fucked. We're like, there's no sugarcoating it. And the world is only going to get more fucked over time. And that's going to drive more investment and more action. Yeah, we'll have blips along the road. We'll have political shifts and administrations who don't believe in climate change. They're nothing compared to what's going to happen in 10 or 20 years. And that's really hard for people to price. It's really hard for people to evaluate how an ecosystem will develop, like a commercial ecosystem will develop as a result of that pressure. How states will react, how federal government will react, how local government react. Like it is really, really difficult to predict. And so that means that people will often look at this sector and say, oh, well, given all these macro things, we can't really make long-term bets. Why would we raise a $2 billion fund into a sector where the federal government might just pull out? And the answer is like, they might pull out, but it won't matter because the world is still going to burn. And it might slow down for a little while, but in 3 years, you'll have a 120-degree heat wave in Dallas for 3 weeks, and 5,000 people will die, and people might give a shit.
Sure. Well, unfortunately, humans in general, right, especially in the Western world and rich countries, until their lives are, like you said, directly impacted by it.
Yeah,
It just goes off to the side, I think,
yeah.
which is, I mean, that's just human nature. So help me understand though, I want to go back to kind of cost of capital and kind of your position in the market. So if you're kind of similar cost of capital to other lenders in the market, so why should folks come to you guys? Like if you were to boil it down to one thing.
So I don't know if I can boil it down to one thing, but I can boil it down to a few things. So one is that we are faster and say less work than many of the alternatives, right? So we might be the same price as another lender, but they'll take 2 or 3 times as long to do the deal. Two is that oftentimes our pricing comes with terms that generally would not be associated with the same kind of pricing. So like we might be coming at 16, but we're not requiring a personal guarantee, which is a pretty material difference, right? Three, I think that oftentimes people forget that when you work with a capital provider, you have to really deeply understand how they operate when things go wrong. And this is obviously not something that we can put on paper. We're not going to like say, hey, we'll be nice to you when shit blows up. But historically, we have taken a posture where we say, okay, as long as we don't feel like we are in immediate danger, we're going to work with you to make sure that you stay solvent and that you can navigate this period. So we have borrowers who, we did what we thought was a year loan and things went wrong. And we modified it so that they didn't go out of business. We could have said, hey, actually, you owe us the money. Fire all your people and sell your equipment because you got to pay us back. And instead we said, hey, why don't we just extend the loan by another 9 months and we'll adjust the amortization for you. And yeah, actually, in the end, we end up making more money because the loan is outstanding longer. But the way the payments work allow you to stay in business. And most private lenders and most banks will never do that. They will protect themselves at all costs. And what's interesting is you would think that with that posture that I just described for us, we would have a high default rate. We don't.
Yeah, I think you get to a point. You're hitting on a point here, which comes down to like the human element to this and a relationship element to this, right? Which and then that's always balancing scale with like the attention to the
Yeah.
relationship. And but okay, great. No, thanks for that. What you're 4 years in? Is there one or two things that come to mind as kind of the biggest surprise or thing that you did not think of that has happened, good or bad?
Oh man, there's like one every day.
But
I
like a big
think,
assumption you made, right? You had this like
yeah.
assumption
So
there's this
when we
gap.
started,
Yeah.
we thought that revenue-based financing was going to be the instrument that we really built off of. It was really sexy in the market at the time. This was like back in 2021. This was when Clearbank and Cap Chase and Pipe and all these players were really, really big, and everybody was kind of pounding on the door with RBF offers, and revenue-based financing was like the sexy thing. And we said, okay, well, we can apply this to climate. And took about a dozen deals in probably a year where we figured out that it was just not a good credit product. It has applications in limited contexts where it can work really well. But if you look at how most players who still do this work today operate, they're basically doing term lending with like a lot of room for upside for themselves. And it creates really weird incentives. And we just didn't want to do that anymore. And we probably held on to it for a little too long. Like I was pretty committed. I was like, oh no, this is the product. People have figured this out. And so that was, I think, a really big lesson for us. And, at one point we just said, we're not going to do this anymore. We'll adjust. We'll have different structures. I think another thing that's been really surprising lately is that when the Trump administration took over, we thought federal support for climate was dead.
Sure.
And if you hear the stories today and the narrative today, that is what people think is the case. But in reality, that is not the case. We are still seeing grants being issued to climate startups all the time out of the federal government. Of course, the volume has declined, but the biggest impacts have been at the like nonprofit and academic level. For a lot of small businesses, there's plenty of funding available, in There's like just recently there was a massive funding opportunity announced around critical minerals, which is like one of the biggest issues in climate, right? And so it's been kind of surprising, right? And this is not to say that like we shouldn't care about what they're doing. The damage is catastrophic. It is monumental. The implications to our business in the short term have not been as material as we thought.
That's good to hear. I mean, I think it's important that because like I said, I think media narrative that takes in people's feeds, because most people are low information people in general, is because they're busy or they're not digging into things. It's good to get that perspective that, and I'm glad that it hasn't impacted the business and potential borrowers as much as you would think, and that it's still active. So it's really good to hear.
Yeah, I mean, I think, look, again, to be clear, right? I don't want to minimize the damage,
Mm.
right? And you might ask someone who had their NSF funding pulled, and they're going to tell you that it is catastrophic, and
Sure.
they're not wrong, right? But I also think that it is really easy for founders to see this narrative and give up and say, okay, I'm not going to go after this money. This money isn't available to me. Like this administration's hostile. It's a dysfunctional government. They're not going to pay me even if they contract with me. Like there's all of these things going out there. Or, oh, I'll lose the grant after I get it. Like for example, there was just this executive order around federal grants. And one of the things that people really latched onto was that the federal government said, well, all grants will have a termination for convenience clause. We can just terminate anytime we want. And the reality is this is always the case. This is a standard staple of most government grants, unless they get really, really big, where like you can't, that's $7 billion. Like you can't just terminate for convenience. Like that would be ridiculous, right? But most government grants, most SBIRs, almost all of this funding has a termination for convenience clause. It always has. And the administration's like taking credit for like adding real oversight. And it's like that's always been the case. And so I think what people need to kind of do is to say, okay, well, if I want to be an effective entrepreneur, I need to have a real understanding of how the capital market can support me. And that includes every source of capital. And if it's not the federal government, like maybe there's state grants for you, maybe there's city grants for you, maybe there's county grants for you, maybe there's private philanthropic money that's available to you. Maybe you can go get some cash from a DAF. Like there's this entire universe of capital out there. And the thing that we've seen time and time again is that founders will go and they'll say, okay, well, I'm going to learn everything there is about AI. I'm going to learn everything there is about marketing. I'm going to learn everything there is about, sales ops. But when it comes to like capitalizing their business or managing their finances, it's this like weird secondary priority. They're like, I'll just raise venture. It doesn't matter. We'll figure it out. And it's just shocking to me.
Yeah, it's funny, man. You can say this. It's interesting. You can say the same for like in people's personal lives too. It's shocking to me. I'm not a good person to ask because I have a finance background, and so I'm pretty financially literate. But the amount of professionals and people in all types of walks of life that well educated that have zero understanding of finances, it's wild to me.
It is, when I work with a lot of founders, we do a lot of coaching at accelerators. We kind of work with a lot of very early stage companies also. And the thing that I tell people time and time again is like, it is just as important for you to understand your financial journey as it is for you to understand your product journey, your R&D journey, your hiring journey. Like it is on par, if not more important, because the decisions you make around capital today will shape how you operate your business forever.
You hit on this is very interesting. You hit on a really big piece for me that I'm going to spend a lot of time on over the coming months, which is exactly what you said, which is there's two things in operating a business, because everyone struggles with this idea of what everyone's really looking for, right? Is okay, I want to like have some success with what I'm doing and potentially have good outcomes financially, but I also want to have a lot of impact, right? And I want to feel good about what is it I'm doing, not just something to make money. And I tell people all the time, there's two things. There's your capital strategy, which is what you just said, right? It is like it determines your decision making, and people do not understand this, and it's so critically important. It will affect how you think about the business and how you the decisions that you make. And then the second thing is when you have a company or an organization, you need to make sure whatever you want to say business model, but which just means incentive structure, right?
Yeah.
It needs to be aligned with the outcomes that you want. And it's very easy, both on the capital side and business model side, because the market may pull you in a specific direction to compromise on that. And I understand why it's a really hard thing to balance, but I'm just glad you brought it up because I feel strongly about that point.
I mean, I think the reality for a lot of founders is that um, oftentimes it doesn't feel like a choice. You'll be in a position, you're running out of money, you have to take some capital from someone. The terms aren't great, you just have to do it. And I think the thing that people forget is that actually you had a choice 6, 12, 18 months ago, and you didn't make it then, and now you're in this position. And sometimes, look, it's also like worth noting privilege plays a big role here, right? If you're a white guy entrepreneur from a middle class background, the options you have for financing are very different than if you're a woman of color coming from poverty trying to start a business, right? And like obviously those choices that you have available to you at any given time, the resources you have, like it's not free to have good financial planning in your business if you don't know how to do it yourself. I understand all of those constraints. But I think oftentimes people forget as they make those initial steps that they have a choice about where they invest their limited time and resources. And oftentimes they just choose not to say, okay, well, I'm going to spend this week understanding what capital options are available to me, how to put them together, how they relate, what is the timing, right? Like oftentimes people will come to us and they say, hey, we are running out of cash. We want to borrow money. And I'm like, you should have borrowed money from us 9 months ago so that you wouldn't be running out of cash today. Because now that you're running out of cash, we can't lend you money. And so I think it's this like, this is why one of the things that we chose to do very early on at Enduring Planet is to provide free support to the climate ecosystem to help people understand finance. We have a weekly blog, is very tactical. It's like all advice. There's no, oh, here's the state of the market, fluff bullshit. It's like, here's how you raise money from this group. Here's how you navigate this part of a transaction. Here's how you think about your data room. So we do that. We also have a monthly series where every month we put together an event. It's 90 minutes, which seems way too long. And we just like go really deep on finance topics. So in next week, we're doing one around, well, how do you finance commercial deployments in climate in this economy? Not 6 months ago or 12 months ago when it was easier, but today with the current tax credit structure, the current rebate structure, with the current, capital market appetite, like how do you finance these projects? And so we spend a lot of time like trying to get founders smarter about money. And we don't get paid for it.
Yeah, it's great. I mean, it's part of the caring about what you're what you're
Yeah.
doing, right? At the end of the day. All right, you wanna we'll wrap it up a little bit of rapid fire.
Yeah, let's do it.
Okay. What's one myth about climate finance you wish would die?
That you can't make a return while making an impact.
Who's
Like you have to this notion that people have to like get less money because they're doing good is just drives me insane. All right, you said wrap it. I'll keep my
no problem.
commentary to a
We could
minimum.
go on that thread for a long time. Who's one person in climate or tech or policy that's really influenced how you think about kind of this problem and influenced you to kind of start this and dedicate, all of your time to it for?
Oh my God, there's so many, but the one person that comes to mind, there's a guy named Michael Grossman, who is the Chief Investment Officer for Climate United, which is one of the largest GGRF recipients, and he's probably the most influential person in impact finance that I know and love and appreciate.
What's the most overlooked opportunity in climate tech right now?
All of them.
Who else? Who else? around this theme of decentralized, funding or decentralized infrastructure in general, should we have ongoing direct?
Oh, that's a hard one. I have a very long list. You should follow up with me after,
Okay.
like a very, very long list. Yeah.
Um, your last meal on Earth, what are you ordering?
Something with chicken in it.
Okay. How can people reach you or get involved or apply for funding
Yeah,
for
so
Enduring Planet?
we're at enduringplanet.com, just enduringplanet.com. You can email me directly at Dimitry, Dimitry, Dimitry at enduringplanet.com. We also have a contact form. I'm also on LinkedIn, Blue Sky. Hit me up.
Cool. Well, we'll include that in the show notes. Well, thanks, Dimitri. I appreciate it, my man,
Awesome.
and enjoy the rest of the day.
Thanks so much.